All right, well, happy Monday morning. Welcome to Learning Objective 4 in Chapter 4. What we went through the last part of Chapter 4 were all the adjusting entries. The adjusting entries, as you know, go in the journal. And you know what happens with anytime we put information in the journal, what happens to that information? That's an open question. What happens to that information? You write something in the journal, because you've been doing journal entries. What happens to that? Dennis, what do you think happens to that information you put in the journal for those adjusting entries?
I'm trying to remember. It's not processing.
Sorry?
I'm trying to remember. It's not processing at the moment.
Okay, now you're trying to remember. I can't hear, you're kind of a muted sound. I can't really hear you too well. I'm sorry. That's okay. Well, anything that you remember what I said earlier about this chapter, you can't forget anything you guys did in chapter 3 because it repeats. So let's go back to chapter 3. You were writing entries in the journal. What happened to those entries after you put them in the journal? Does anyone remember? Remember the numbers travel? Every time you write in the journal, then those numbers travel. So that's the only hint you're going to get today. What happens to those numbers? I think I should get a pot of coffee going. Just and spread the cheer here. What do you think? It gets posted in the ledger, right? Every time you put something in the journal, it goes to the ledger every time. And all these adjusting entries are happening in the journal. As a matter of fact, all the entries are happening in the journal because that's the first place accounting the first place accounting is recorded is in the journal. So once you write anything in the journal, you can be rest assured, okay, as the sun's coming up every morning, that those numbers are traveling to the general ledger. They're going to the ledger account. And those accounts in the ledger are being updated, okay? So think about all the adjusting entries you learned in the last couple of objectives, right? You adjusted supplies. What was the transaction to adjust supplies? The two accounts that are affected. And this is an open question as well. Maybe I'll just go down. Marcia, when we adjusted supplies, what two accounts were affected?
Supplies expenses.
Supplies expense and supplies, right? Two accounts are right. Supplies expense and supplies. So you wrote that in the journal. Guess what? Those numbers are traveling over to the ledger, and now supplies has a new balance because that balance was just updated. And supplies expense has got a new balance because that was just updated. Yes? Brandon, we also adjusted insurance. Do you remember the adjusting entry for insurance?
It is prepaid insurance.
All right, so we have to lower our prepaid insurance.
And then insurance expense.
Right. So we debited insurance. That's right. We had to debit insurance expense and we had to credit prepaid insurance because we're adjusting, right? So you wrote that down in the journal. And as soon as you write that down in the journal, guess what? It travels over, gets posted into the ledger. So now prepaid insurance has a new balance and insurance expense has an updated balance as well, right? The third accrued expense we did, Elizabeth, was depreciation, or we had to adjust the equipment, or the equipment account was the one that's listed in the book for depreciation. Do you remember the adjusting entry we had to do for depreciation, Elizabeth?
depreciation expense
Yes.
and equipment? Like-
Okay, well, we had to do the accumulated depreciation for equipment. So we had we had a depreciation expense, so you're absolutely right there, right? We debited a depreciation expense, but the credit goes to that accumulated depreciation for equipment. Equipment actually has like a buddy account right underneath it for accumulated depreciation,
Okay,
right? So accumulated depreciation for equipment will get the credit. So as soon as you write that in the journal, it travels, it gets posted into the ledger. So now depreciation expense has a new balance and accumulated depreciation for equipment has a new balance. And then we had to adjust revenue. Josh, we had deferred revenues, right? So this is when customers paid us up front. We had that unearned service revenue sitting there. And when we did the adjusting process, we wanted to make sure that that is still true. Or did we actually earn some of that? So Josh, do you remember the deferred revenue adjustment that we did? The two accounts that were affected when we did that entry.
I can't seem to remember
Okay.
right now.
All right, that's fair enough. I'll get back to you. Yasmin, do you remember?
What was the question?
We did those deferred revenues. Remember, we had unearned service revenue, and then during the adjustment process and learning objective 2, we had to make sure that we didn't earn any of that stuff. So there was an adjusting entry we had to do with unearned revenue. Do you remember that one?
Was it accounts receivable and service revenue?
That's the accrued revenue. That's learning objective 3. So that is an entry, but that's the accrued revenue. In this case, we debited unearned service revenue and we credited service revenue. Remember, the deferred revenue is we had the cash sitting, but we also had this unearned revenue, which meant we had to wait, right? The deferral is to wait. We had to wait, deliver what we promised to deliver. And now the unearned revenue becomes earned revenue. So unearned service revenue is decreased with the debit and service revenue is increased with the credit. So that was the adjusting entry there. So as soon as we put that in the journal, guess what? Those numbers traveled and we updated the ledger. So now unearned service revenue, that balance is adjusted and we have more revenue. Service revenue is adjusted. Now we're moving on to the accruals. So Yasmin, you're going to start us with the accruals because you had this one right. We had the accrued revenue, which means we wanted to make sure we had the revenue in the record now, and we're going to collect it later. And so there you were right? You debited the accounts receivable. You had to set up an accounts receivable to show you're going to collect it or receive it later, but you're going to credit service revenue. That was learning objective 3, the accrued revenue part. And so that adjusting entry gives us a accounts receivable, but also increases our revenue. As soon as we put that in the journal, it gets posted to those accounts in the ledger. Those accounts are updated through that adjustment process. Let's keep going. We actually had 2 adjusting entries for what we call the accrued expenses, right? Expenses that we want to take now, put them in the record right now for this period, although we're going to pay them later. And there were 2 of them that we reviewed in objective 3. So Brandon, good morning. I see you're all snug as a bug in a rug. That's the old saying we used to call it. So do you remember by chance, I know you just woke up, but do you remember by chance the accrued expense that we had to do for either interest or salaries and wages? It's your choice. Those were the 2.
Oh,
Do you remember what we debited and what we credited?
what we debited.
Or the 2 accounts that are affected, and we'll fill in the blanks.
Okay, hold on.
Hmm. It's not assets, no,
No.
no.
Okay, I think we got a spill in aisle 4, Brandon. So just, All right, we can move on. Thank you. Thank you for trying. Who would like to tackle that? Who's left here? Lucas is here, Josh is here. Anyone want to tackle that one? All right, well, this was just your homework for the weekend, so I thought you might remember. So for
May
the
I try?
one more time.
May I try?
Yes, absolutely.
So we debit in interest expense and credit interest payable.
Right. So for the interest, remember, we have to make sure what is our interest expense for the period, which in our book's case, they focus on a month at a time. So what's the interest expense for that month? And so we calculated that, we put an interest expense, and then we added interest payable because we're going to pay it later when the note is due. And so as soon as you put that in, those accounts get updated, right? I mean, you put those in the journal, they post automatically to the ledger. So now those balances in the ledger have changed. And the very last one was for salaries and wages, yes? And does anyone remember that? No. Right, so it works the same way as the interest, right? We had to debit the salaries or wages expense to show the salaries or wages occurred this month, but we have to set up a salaries or wages payable to show we're going to pay them in the next time period, right? So all of those are the adjustments. You'll see them, right? Because we're going to be looking at in this is something called an adjusted trial balance in this part. An adjusted trial balance basically is the trial balance after the adjustments. So remember, learning objective 2 and learning objective 3, we were doing all these adjustments, right? Now it's time to look at the trial balance after the adjustments. We call that the adjusted trial balance. Okay, so it's the trial balance after all the adjustments. Take a look at it. Take a look at it. If you have your book handy, page 171, get a close-up look at this if this isn't good enough for you. Here's the adjusted trial balance after we did all of those adjustments in learning objective 2 and 3. Now we have accounts that balances were changed. And you'll see those with the red numbers here. So all the accounts that have the red number listed are the accounts that are part of the adjustment process. Okay, are part of the adjustment process. So you know why accounts receivable is adjusted by $200 because we also had to record that revenue. Because accounts receivable and service revenue are part of the adjustment that we learned in objective 3, accrued revenue. You know why supplies has a new balance of $1,000 because from learning objective 2, we had a supplies expense, which you'll see down here, supplies expense, and we adjusted supplies. So we know those two accounts are affected in the adjustment process. Just like I said earlier, the accounts receivable and the service revenue are affected. Service revenue also is a red number because it's affected by the process, yes? You notice that prepaid insurance is affected. That number is also red, which means it changed, the balance changed. Why did it change? Because we had an insurance expense. Do you see how those are matched up? Not just in the adjustment process, but now those balances have changed on the trial balance. In other words, the trial balance is just looking at the ledger and making sure what the balances are. But anything you put in the journal affects the ledger. So we were just doing a whole bunch of adjustments. So those adjustments affected the balances in the ledger. So now we're doing an adjusted trial balance because this is a trial balance after the adjustments. Okay. We have accumulated depreciation now. Why? Well, because we have a depreciation expense, yes. That's part of the adjusting entries. We also have interest payable. That number is in red. Well, why? Because we have an interest expense, because that's part of the adjusting entries. You learned, I mean, there were 7 adjusting entries that you had to focus on. That's it. I mean, there are many, many more in reality, but this book focuses on those 7. That's the only 7 adjusting entries you need to know. And they're outlined pretty well in your book. Here we have unearned service revenue was adjusted. Why was unearned service revenue adjusted? Well, because we had to make sure that some of that revenue is in revenue, right? Some of that revenue needs to be on the income statement because we earned it in that period. So we had to do an adjustment. That's part of learning objective 2. We had a salaries and wages payable because we had to adjust salaries and wages expense, right? Do we see how this comes together? So now, after all those adjustments happened at the end of October, we have several new accounts that are part of our ledger now. And some of them for the first time have balances, like your insurance expense and interest expense and depreciation expense and supplies expense. And some of them just are balances were changed. They were there before the adjustment process, but now the balance has changed. Like salaries and wages expense, like service revenue, like unearned service revenue, like supplies, like prepaid insurance. They had balances before, but after the adjustment, those balances have changed. Okay, so the adjusted trial balance, again, looking at the ledger accounts after the adjustments that we just did, because adjustments are recorded in the journal, and from the journal, they go to the ledger. So those particular balances have changed at the end of the month after the adjustment process. So now we have to make sure that our ledger is balanced, and we do an adjusted trial balance. As you see, the accounts that have a normal debit balance and the accounts that have a normal credit balance are equal. They're equal after the adjustment process. So we know that our adjustment process went well, and we can see that in the balances. The adjusted trial balance is the document we use to create our financial statements. So now that we've done all those adjustments, and now we have an adjusted trial balance showing the new balances in the accounts that were affected. Notice cash isn't affected because cash is not part of the adjustment process, right? Did we ever talk about cash in the last 2 objectives? No. So cash is never affected by the adjustment process, because the only thing we're doing is we're adjusting our revenues and expenses with some of the asset accounts and some of the liability accounts. Not all of them, just some of them. So the cash balance is the same, but now we have an accounts receivable account for the first time with a new balance. Well, you can't ignore it. That's supposed to go on a balance sheet now, right? And then all your other balances that are turned red simply means they had gone through the adjustment process in the last 2 objectives. So now that we have an adjusted trial balance, we are actually ready to do our financial statements. This is how the financial statements are created from this adjusted trial balance. These numbers mean that we have great confidence that it's accurate. Why do we have great confidence that it's accurate? We've already done all those adjustments. Okay, so we feel the information is up to date, relevant, and accurate. Okay, and complete. So now we can prepare financial statements. We prepare the financial statements from the adjusted trial balance. This is where we get our numbers to do our financial statements. So of course, the very first financial statement we do is, I'm all ears. What's the very first financial statement we do?
Income statement.
Thank you. The income statement. Exactly. So the income statement, then we do the retained earnings statement, then we'll do the balance sheet. Okay. So here is the adjusted trial balance that we just saw on that page. It's on page 171 in your book. But if you want to turn to 172, you'll see this graphic in your book, this illustration. Okay. Notice that the very, very first thing we do is the income statement. And the income statement has the revenue and expenses. Yes. So where do we get the number and the account? Well, we get it from the adjusted trial balance. There's only one revenue account, service revenue, and the balance is now $10,600, right? So service revenue now is $10,600. This $10,600 before the adjustments was only sitting there at $10,000. So because of the adjustment process, we actually added $600 more in revenue for that month. Okay. Had we not gone through the adjustment process, revenue would have been understated, right? The number we reported would have been lower than the actual number. And so that's why it's super important to go through the adjustment process, just so we can say that our numbers are accurate as we know, okay, because of that. So the revenue account is listed, service revenue, $10,600. Our expenses, well, look, here's all our expenses right here. We're just simply taking the expenses and the balances right off of the trial balance, the adjusted trial balance, and putting them on the income statement. That's it. These numbers here are exactly the numbers you see here. Of course, they're totaled for $7,740 of expenses for October. So October looked promising, right? Because we had $10,600 of revenue, and we only needed $7,740 of that to cover our expenses, which means the difference, the excess revenue, is our profit. Net income is the same as earnings, is the same as profit, right? Those numbers, those terms are all interchangeable. So now we had a $2,860 profit for the month of October. How confident can we be that that number is as accurate as we know? How confident should we be? Pretty damn confident. Look, we look at the adjustment process we went over. We were double checking, to make sure all the revenue is there. We were double checking to make sure all the expenses are there. We can say we have pretty high confidence that this report is accurate. Okay. And that's why we have to do that adjustment process. We want to make sure that if we're going to report financial statements, they better damn well be as accurate as we can make them. Right. So that adjustment process is really critical here. All right. So now that we're pretty damn sure that's the real profit for the month of October, we can go ahead and do our retained earnings statement. Sierra Corporation is a brand new company in our book. It just started in October. So it has no beginning balance in October the 1st for retained earnings. But we just had a huge profit in our first month, $2,860. So we're adding our profit in. It says here we pay dividends. How do we know we pay dividends? Well, it's right here on the statement we're supposed to look at to find all the numbers. The adjusted trial balance is the statement we look at to find all these numbers to do our financial statements. Okay, so we show here that there were $500 of dividends at the end of October. So we subtract out the $500 of dividends. And what we get at the end of October is retained earnings of $2,360. That's the amount of the profit that is being retained, because $500 of the profit has gone out of the company, which is why we subtracted it out of our statement. Okay, so this is the first stop. Okay, this is the first stop. We now have noticed, I want you to notice too, that on the adjusted trial balance, the retained earnings balance is shown as 0, and that's where this comes in. Obviously, our ending balance for October 31st of 2360 will become our beginning balance for November 1st. Does everyone understand that? The ending number on October 31st becomes your beginning number November 1st. Okay. So this is where we have to check the balance and retained earnings. That's just the beginning balance. We don't know the ending balance without doing the income statement first, and then adding that net income, and then taking out any dividends that we might see. So the ending balance for 1 month is the beginning balance of the very next month. Okay. And you might see that on homework or exam. Now what we have is all the information remaining goes on the balance sheet, right? Assets are listed first in the order you see them here is the order you would see them on your balance sheet. Total assets of $21,900. Notice how equipment is listed, and then the accumulated depreciation on that equipment is taken away, right? Because this is how much we've depreciated. This is how much we've already expensed of that equipment. So that's the book value, and that's also important to understand as we go. So again, all the accounts are listed here, and that we got all the asset accounts right from here. We don't. There's nothing to guess. Everything is given to us right there. We're just transferring it onto the balance sheet here. Liabilities are listed next on our balance sheet. And here are all the liability accounts. Those are the numbers that we use, and that's what you see here. Total liabilities were $95.50. Stockholders' equity, well, we know we had $10,000 of common stock. The retained earnings, we don't look at this number because we have our retained earnings statement done. So the retained earnings statement tells us what the retained earnings balance is now at the end of October, because we had to figure that out first before we could get a balance. 12,360 in stockholders' equity. Liabilities and stockholders' equity give us 21,910. So our assets indeed equal our liabilities and stockholders' equity. This is the next step. This is really the work that has to get done in this part of the chapter. So we want to make sure that our earnings are of high quality, and we go through these processes to make sure that our revenue is accurate, our expenses are accurate, so we can basically provide a clear pathway to say this is all the information we have and it's reflected in our numbers. Okay. So it's really important that we do the financial reporting properly, and we follow the steps that are there for GAAP, so we can be very, very clear and careful that our numbers are accurate. Okay. This particular do it exercise in your book, by the way, I just want to explain a little bit of that. This is all on page 174, and it's something that you would study. That's a really bad 7 and a really bad 4, a little thin. But here we have this company Slotnick that was organized on April the 1st, and we're doing, we want to prepare quarterly statements for June the 30th. So it's a quarterly statement. So this is one of the few exercises. Usually your book focuses on a monthly statement. This is one of the few exercises that show you a quarterly statement. Well, what does it mean? It's simply, all this information is about a 3-month period of time rather than a 1-month period of time. That's all. So the first thing they ask you to do is to determine the net income for the quarter, right, for the 3-month period. And so what do you know about that? Well, you have to make sure you know what your revenue is. So you have two revenue accounts in this particular company, service revenue and rent revenue. Okay, there's two revenue accounts here. And then you have a whole bunch of expense accounts here. Okay, all of these are expense accounts. So you know how an income statement works, right? It's your total revenue minus your total expenses. That'll get you your net income, right? Your book doesn't actually have a formal income statement. Oh, actually it does. Okay, good. It doesn't have a heading. But as you see, we have total revenue of 15,000, total expenses of 12,510. So actually this company for the quarter recorded a profit of $2,490. That's good. That's good. So now we know the profit. The next thing they wanted us to do here, and which is why it's not the most ideal. What you would normally do is then do a statement of retained earnings, clearly. The dividends information is given to you there. This particular company is brand new, so it starts, the starting balance, the beginning balance is 0. You would add the net income that you just calculated, subtract out the dividends, you'd have your retained earnings balance. Here they want you to basically do a balance sheet B and C. They kind of broke it up. I would have done it the opposite way. They want you to do a balance sheet. So here you have all your asset accounts listed right here, including accumulated depreciation is going to be with equipment. Right. And then you have all your liability accounts here, and your stockholders equity account, common stock, and the retained earnings statement that we just did mentally at least. So here, what your book shows you is your total assets. Again, all these are, it should be in more proper balance sheet form, but again, no book is perfect. Total assets of 23,350. Here you have the equipment account, less that accumulated depreciation for equipment. This is how much of the equipment we have already expensed through depreciation, leaving what we call a book value of 14,510. So all of these are added up for your total assets. Your liabilities are listed pretty clearly. You have total liabilities of 7460. Clearly, the difference is going to be your stockholders' equity. Retained earnings was 1890. You add that to your common stock account of 14,000 and you'll balance. Again, this particular do it exercise is not ideal to review, but you would normally just put the statements together and they don't have that there. But I just wanted to explain it to you and with you. But the homework you'll have will be more formal than this, where you'll need an income statement, a retained earnings statement, and a balance sheet. All those numbers are taken from the adjusted trial balance. Okay, again, the adjusted trial balance is where we get the numbers for our financial statements. That's the location. Okay, so come back to our main screen to see if there's any general questions on that. Okay, so to this point, let me just make sure you understand what you need to remember. Okay, what's important, because there's one more thing to do in chapter 4, and we'll do that on Wednesday morning. It's called the closing entries or the closing process, and it's relatively easy. So I like to finish up on that. But what you have to do now is understand that adjusting entry process, right? So learning objective 2, learning objective 3, adjusting entries. As soon as you put that in the journal, they post to the ledger. So now you have a ledger that has some balances that have changed because of the adjusting process. So we have to put together an adjusted trial balance and make sure all our ledger is now balanced after all those adjustments. And if it is, we have our numbers. We can do our financial statements. Okay. And you know how it goes. Income statement's always first. Retained earnings statement is second. Balance sheet is third. The numbers we get for that are directly from the adjusted trial balance. Mhm. So I want you to kind of focus and work on that through Wednesday morning. When we get together on Wednesday morning, we're going to finish chapter 4. It's actually quite brief. And then I'm going to, I mean, there's this much more homework to do. I'm also going to be releasing the exam. I'll be giving that exam more time. So we'll go through that exam. Will be opened Wednesday, but it will actually go through the following Monday night. Okay. So if there are any lingering questions, we will at least be able to meet one more time before you finish up the exam. Okay. I would also say this is sort of the last big exam in terms of actually creating statements. All the other information that we're going to be covering after this chapter is more analytical and less, there's some bookkeeping, but not a lot. It's a lot more analytical. And so you're going to find a huge difference in both the pace of the course and exactly what we're covering after we're done with chapter 4. It's going to move at a faster pace, but there'll be less time-consuming statements to be doing. Okay. Sort of a deep dive into the accounts to understand what they mean and how they work. So it's a different look from chapter 5 on. It'll be different. But that's really the focus for this. This is very important to finish the accounting cycle. We'll do it on, we'll finish up everything by Wednesday, and you'll be, I think you'll be fine. But this is the time to put in the extra work to make sure we're doing the adjusting entries. We'll make sure we understand the adjusted trial balance. Is the trial balance with all the new balances from all those entries we did? And we're creating the statements from there. Drugs are bad. Spring water. Puts a spring in my step. How about you? Okay. All right. Well, if there's no questions, I'm going to stop the recording.